What's going on, everybody? It's Matt Fortier with Keller Williams Realty and United Home Group, here with a big market update. I mean, it's big just in the amount of content. As you'll notice, I've got 3 links below covering 3 topics: current home prices, inflation and impact on rates in the future, and proposed changes to the United States tax code, which may impact investment property owners as well as the overall market. Let's get into this. So first of all, if you've been living under a rock or in a cave, you might not know prices are pretty insane right now in the real estate market, especially here in the Sacramento area. And a good friend of mine and real estate appraiser extraordinaire, Ryan Lundquist, has his monthly market update, which I've linked below, and I'll speak to a little bit here. And the title is "Home Prices Are Insane." Home prices are nuts. Again, if you haven't been living under a rock or in a cave, that may not be a shock to you. What does that mean to us, though? Well, obviously, if you're looking to sell your house, or if you've been thinking about selling your house, likely chance that you've got a substantial amount of equity. I mean, substantial, even if you bought just 3 years ago. So if you've been thinking about making a move, or you're thinking about maybe moving out of state, or you've been thinking about selling off some rental properties to consolidate, or just to get out of the landlord business, we're definitely in an era, and have been in an era, of substantially great prices on the sale side. Now, of course, the flip side, you're looking to buy, and fill in the blank, bloodbath, crazy. I'm not going to lie to you. As a buyer, it is kind of tough. I mean, competing here's the Sacramento area. In last month, 75% of all home sales had multiple offers. And where was it? Oh, and so 3% of them had more than 20 offers. So, yeah, kind of crazy. Though at the same time, this was actually eye-opening that about 20% of all home sales in Sacramento, is it 20.4 in 2021, have been under 400,000. So it's you think 400,000, wow, that's a lot of money. Though in the current rate environment, it's still somewhat affordable. So there's still opportunities out there, even if you're in the starter home market. Again, it's still kind of a tough market, and I get it. And if you're interested in making that move, or you're interested in selling and buying, obviously that's a great one-on-one conversation we can have about devising a plan to help you find that place and win the deal. This isn't about how we win the deal. This is just, let's talk about the market so you're informed. Now, you look at this, you read this report from Ryan, and you might think, gosh, I just want to sit on the fence. This is just crazy. It's got to come down at some point. He talks about it a little bit here, but really the big driver in this, it's supply. Ever since the big 2008 crash, the new housing starts have not been at the level to even keep up with population growth. So at the fundamental level, we have not been building enough new houses, now here in California especially, but across the country. This is nationwide. We have not been building enough to sustain, or to meet the demand of just the growing population. So what does that have? I mean, you can look at, and I've got the link below on the market trends, and I wish I could flip to like a really cool screenshot to show you over time. The supply over the past several years is kind of steadily been coming down. The number of sales and pending sales has been pretty constant. So with new housing starts, I mean, they're scrambling. I mean, I can look across the way here and see the south of 50 Folsom project. And I mean, they are trying to build as much as they possibly can. They are moving as fast as they can to put as many homes on the ground as possible. But we're playing major catch up, 10 years of catch up. And so that means supply is going to be tight. And so if you've been thinking about waiting it out for the market to soften or for the market to crash, totally separate conversation. We're not going to jump into deep in that. With the supply as it is, it's not likely to see some major substantial downturn in prices, which leads to the second topic. And oh my gosh, we're 5 minutes in and I just got to the second topic. I'll make sure to put on the description this is a bit of a long one. Again, I encourage you to read all the information down below and even do some additional searching to find out. So let's talk about topic number 2, inflation and interest rates. Now, good segue from the previous part about, hey, I want to see if prices go down. Okay, even if they do start to go down, I'm sure you've seen plenty of memes and jokes about, the cost of lumber and you probably see it at the gas station when you're filling up, or, maybe you heard the news report about steel prices going up. It's true. There's a lot of inflation occurring. And I'm not an economist, so I'm not even gonna go into, this is not alarmist. This isn't like, but at the same time, do a little research on it. But we know that prices are increasing in a lot of areas, and that's the ugly I word, inflation. And one of the things that central banks do and the markets do when we start having concerns about inflation is interest rates start to go up. So what does that mean to us in the real estate world? Well, I don't have my crystal ball and I can't tell you where rates are going to be. Though it's definitely looking that we could see rates start to go up. Now, even if they do go up, it's still going to be good, historically speaking. I mean, I'm sure there's some of you here that bought their first home at 15% interest rates, which I was a kid at the time, and that just seems crazy looking back. I bought my first home 20-something years ago, I think at like 7 or 8%. So even if we're talking about rates going up to 4%, wow, still pretty good. Though, that change from, say, we're at 3 today, 3-ish, we'll just say 3-ish, maybe even sub 3. If we see that go up a quarter point, half point, full point, the impact on your purchasing power based on your budget is pretty substantial. And I think it's every quarter point. Please don't hold me to this. Do your own fact checking. Every quarter point or maybe it's either quarter point or 1/10 of a point, changes your purchasing power by 10%. Something like that. Please fact check it. You can run the numbers, but it's substantial. Let's just say a quarter point is 10%. 10% purchasing power change. If you've got a certain budget, you got a certain dollar amount you can afford based on your financial situation, and all of a sudden that changes 10%, and the market's not going anywhere because, again, supply and demand. If the market prices aren't changing because of supply and demand, and your purchasing power drops 10%, that's so okay. That can have an impact. That will have an impact. So something to think about if you've been saying, hey, I want to sit on the fence, or, I'm going to wait for this to happen. If anything, it's worth having a conversation. It's worth talking to me, talking to your lender, or if you don't have a lender, I can get you in good contact or get you in contact with a good lender. But it's definitely worth having that conversation because, what if if the interest rates go up a point, that's going to be substantial. Again, disclaimer, I don't have my crystal ball. It broke. So we could end up having a flat, and that would be awesome. Again, economics 101 type stuff. Interest rates follow inflation because that's what happens when we just have too much money out there. So just review where you're at, review your goals, and if it makes sense, maybe we can get things rolling for you now before those changes come and take into place. Okay, so topic three. Some of you may have no idea of what a 1031 exchange is. And even if you own investment properties, you still might not know because you haven't gone through that process. 1031 exchange refers to Section 1031 of IRS Code, which allows investment property owners to take property, sell it, and reinvest it into something like kind and not have to pay taxes on it at that time. Defer taxes. They'll eventually come for it, though. As long as you reinvest it into something of like kind, you don't have to pay the capital gains or the depreciation recapture, which could be 30-40%. And that's another thing too. There's proposed changes, not just to this, but there's proposed changes to the capital gains rates, which obviously has that additional impact. But I think even in today's world, I think what long-term capital gains is 30%, 20%, something like that. To be able to defer that, to reinvest into something else, property owners take advantage of this Section 1031 of the IRS Code. It was proposed by the current administration to, as part of their tax plan, to eliminate Section 1031, as well as raise capital gains rates. So whether you own one property or 10 properties or 100 properties, that may have a substantial impact on your portfolio plans. Because right now, if you say you own 3 rental properties, you're like, hey, I'd really like to consolidate, or maybe I want to buy a 5 or more door apartment complex. I just want to do that. Or maybe I want to get out of the landlord business and roll it into a Delaware statutory trust and be a part owner of a Rite Aid or a CVS somewhere. Great, you can do that. Sell your properties, put your money into another investment vehicle, and defer those taxes. Now, if these changes get enacted, now I don't even know where it is in Congress. I don't know if it's even been drafted yet, whether it'll be passed or watered down, whatever it may be. But if there is something like this, whether it's fully enacted as described in the speech or even watered down, that's going to have an impact. Because if I wanted to make these changes without that deferring taxes, I'm going to have to, as a property owner, I'm going to have to pay those capital gains and deferred depreciation or recapturing depreciation, and that potentially higher tax levels. I might be looking at paying 40 or 50% of my net in taxes, and that all of a sudden that totally changes my investment portfolio plans, because that's half of the money I can't reinvest. And again, this is not a political thing. This is not about taxes. I'm sure you can, as a business owner, I want to be able to reinvest as much of my money into my business. So again, non-political. This is we're just talking taxes here, which I guess is kind of political. But hey, so if I don't have that ability to take that money and reinvest it, 50% of that money potentially, maybe more, I'm just gonna let it ride. So that changes my plans. So obviously, if you're thinking about doing that and this starts to happen, maybe it's time to start talking about, well, hey, if I'm thinking about selling or shifting my investment portfolio, now might be a time to at least start having that conversation. Now, also too, if you're not an investment property owner, maybe you're someone that wants to purchase property to live in, like most of us here are. That may have an impact because, in fact, going back to Ryan Lundquist's report here, somewhere in here, and I don't know if this is California, I think it is California, or it might be Sacramento. Either way, it's important. 65% of homes, single-family homes, are non-owner occupied, rental properties. And what did I say before? Inventory. Inventory is one of our biggest drivers of this housing crisis. I don't want to use crisis, our housing situation. So if we can't add inventory, or we're having trouble catching up on building new inventory, we have a substantial locked up inventory, especially in our area. 65% of these investment owners that will be less likely to sell because of the tax implications. What does that mean? That means less homes available for you or anybody else that's looking to buy a home, whether it's your start, hey, it's my first time and I'm, buying this starter home, fixer upper maybe, or, I've worked and earned my way up and I want to buy that 5-bedroom house with a pool. That inventory locked up is going to have an impact. I firmly believe that. If you knew that 50% of your proceeds was going to go away in taxes to sell this offer, to exchange it into something else, are you going to at least think twice about it? Yeah, I would agree too. You are. So that may have an impact now in the future. It could be good in the short term, because if it does get enacted, I would imagine, and if you're one of those property owners that has one or more investment properties and you're thinking, hey, maybe this is the time, talk to me. Maybe there could be an increase in demand or an increase in supply short term, as some of these property owners say, okay, gosh, well, if it does get passed, whenever the start date is, well, I've got to make those moves before that start date. So we could see that. Keep tuned, or stay tuned, watch the market, or come talk to me. We can watch together. Anyways, this has been a long one. Lots and lots and lots of information out there. Take a look at those 3 links and do some Google searching on your own to look into some of this stuff. Fact check me. Especially when it comes to the numbers, Ryan's numbers are gold. But if there's something I said, hey, fact check me, please. I certainly really appreciate you if you've lasted these 17 and 46 and counting minutes. 17 minutes and 46 seconds. Anyways, I digress. If you've lasted this long, thank you. And if you have any questions, reach out to me. All my information's below. I'd be happy to answer any questions you have. If there's anything in the world I can do for you, I'm here. Have a great day. Have a great week. Take care and see you soon.